Hello and welcome to episode 3 of the Technical Bootcamp. Today we are going deep into the concepts and topics of supply and demand. So this is one of the most important concepts in trading. I know I say that quite a lot, but this one is because this is actually what drives market prices. So rather than spending loads of time teaching you the same stuff you've already seen about supply and demand, we're going to start by diving deep into the theory of supply and demand and why that matters so much to become a successful price action trader. I'll show you how to identify and plot supply and demand zones correctly and why we do it that way, and how to successfully trade this theory as a whole. So with that said, get comfy, get some notes ready, and we'll dive right in. Let's go. So supply and demand is basically the driving force behind all the movements that we see in the market. Therefore, whether you're going to use these concepts or not, it's really important you understand what it is that actually makes prices appreciate and depreciate in financial markets. And that is generally basically how much available demand there is in a market, okay? So if we take a look at this chart, we'll explain it as we break it down. Here we have a point where demand is at its highest. When demand is high, supply is generally low. That's because, obviously, with everyone up here buying, supply is taken up. This happens in all markets. Think about the housing market in the UK right now. If you are in the UK, of course. Basically, everyone is buying houses, or there's too many people, not enough houses. Therefore, demand for houses is really high. Supply of houses is really low. So the price of houses appreciates massively, right? So price would look like this with high demand and low supply. You can think of it with diamonds as well. There's argument that this could be inflated value because a company controls all the diamonds, but still they're hard to get. So a scarce asset goes up because demand is high and supply is low, right? Now, if we go the other way and we start to see demand decline, well, what happens as demand declines is people start selling the asset. So the supply of the asset will increase and flood into the market, right? This is true in financial markets as it is elsewhere. If you had a gold coin, for example, and everyone wanted that gold coin, well, you could charge pretty much exactly what you wanted because it's a very scarce asset and the demand is very high. However, if someone else comes along with 100 gold coins and starts selling them off for cheaper, well, suddenly this is not so scarce and they're more available and there's a higher supply in the marketplace. So there's still the same amount of people that want the gold coin, but now there's 100 more gold coins. Therefore, the price is going to decrease because people will see this as a less scarce asset. Supply will be higher, demand will be lower, and prices will decrease, okay? So what we see in the markets then is basically high demand leads to, or the other way around, low supply, or low supply can lead to high demand, right? If people are after scarcity, which creates price appreciation. So if we have not much of an asset and a lot of people want the asset, prices will go up. Think of a Rolls Royce. A lot of people want them, not many people can have them. You can charge what you want for one. People will pay $1 million for a car at that point. Now, if you've got low demand paired with either as an effect of high supply or creating high supply. So let's say, as we said with the gold coin example, you've got high supply now, lots of gold coins in the market. Not too many people are that bothered about them anymore because it's not a scarce asset. So therefore, price depreciates, okay? So this is how supply and demand works. And this is basically the market psychology behind all of the movements that we see in financial markets. If we have a case where there's high demand for an asset, so there's a reason for people to want to hold a specific asset, then supply will be bought up, it will get more scarce, and people who have the asset can then charge more for it. That will mean price appreciates. Low demand, so if not a lot of people want to buy that asset, if something bad happens to a currency and people start selling it off, then of course the demand will decline. That will create more supply because supply will be being sold into the market, and that creates price depreciation. Not so many people want it, and loads of it's available. All right. Now let's explain then how this actually comes to be in a financial market and how this actually affects the prices. Okay. So obviously we know high supply, low demand creates price depreciation. Low supply, high demand creates price appreciation. So with that in mind, what is it that actually causes that then? So how does this actually make prices go up and down? Well, it's very much like an auction theory. Okay. So let's say price is trading at this level. Now, suddenly there is a reason that people want to hold this asset. Well, now we have new people stepping in. So these are the new people coming over. These are the people that hold the asset. What these guys are going to do is now say, well, if you want the asset, you've got to pay me this much, okay, here, instead of this much where they got in. Someone's going to take that, and then what's going to happen if there are still people coming in for more of this asset? The next guy, this guy here, is going to say, okay, well, if you want to buy it off me, you got to pay this much, okay? So then someone's going to come in and take that, and then the next guy who's holding the asset might come in and say, well, you got to pay me this much, right? So basically, because people want the asset so bad, they will continue to pay higher prices, which is what creates the upward movements in the market. Now, let's say we get to a point where the direction shifts. People are less interested in having this asset now for one reason or another. Maybe another asset has become more appealing. Maybe this one has lost its yield or something negative's happened and people don't want this anymore. Well, all of these people now will start selling. So let's say we have the holders again. Someone's going to be like, can I sell this here? And a buyer might come in and buy it there. This is the guy who's buying the top. But then as it starts to depreciate, because there are less people in this pool than there is in the pool of holders over here, people that already own the asset. Well, now if you want to sell the asset, you're going to have to say, well, I'll sell it you at this price. And then someone's going to come and take it. But basically, because there's less people willing to pay these prices for the asset, the owners of the asset will have to keep dropping the price to meet demand. And when demand is met, then we may see a new drive higher when we meet a price that people are happy to start buying in at again. But essentially, what's going to happen there is, the price is just continuing to depreciate to basically meet the price of which demand exists, okay? So if you wanted to buy a car off me and I had this car and you didn't want to buy it at this price, I might have to lower the price down to here, see if you'll take it. If you're not gonna, I'm gonna have to keep dropping that price, okay? That's basically what we're seeing happen in the real markets. And although these drawings have been messy, I'm pretty sure you've hopefully caught along with them. So that's basically how supply and demand works. It's the same everywhere. Some reasons why, just very briefly before we get into actually using this, why demand may increase for an asset. Let's say we have the US dollar and the interest rate on the US dollar is 4.5%. And then let's say we have the euro and the interest rate on the euro, these are random numbers by the way, is 2%. Well, if you're now thinking of holding one of these for the long term, which one's going to be more appealing? Probably the US dollar, right? Because if you have $100,000 in the US dollar, you're going to gain $4,500 a year for holding that. Whereas if you have $100,000 in euros, you're only going to gain 2,000 euros a year for holding that. So there's a better yield in US dollars, which therefore is going to make the dollar go up and the euro go down, because people holding the euro will sell, opening up more supply and decreasing demand, and they will buy US dollars, which of course minimizes the supply or sinks the supply a bit and increases demand, okay? So that's one of the reasons why we may get supply and demand differentials in the market. Another one could be what we call risk on versus risk off, okay? I'm sure we'll go more into depth on these, but to understand just the basics of what drives currencies, we'll go through it now. So a risk off currency is a safe currency. Again, like the US dollar, safe haven currencies, right? The yen does pretty well. The Swiss franc, these are seen as safe havens, safe assets to put money in that are generally stable in hard times. So risk on assets when market sentiment and traders are happy to take on a bit more risk, that's going to be pretty much everything else. Things like the euro, the pound, the Aussie. These things are a little bit more speculative. So in a bad economic time, money will outflow these because people want to put their money somewhere safe. We see demand for these increase, therefore we could see price appreciation in these assets, okay? Also gold. If we take a look at gold right now, that's exactly what's happening, right? Let's just head over there. Gold right now, if we take a look at the weekly, gold, silver, these safe assets, these long-term assets, they're parabolic, they look like crypto charts. Why is this? Well, this is simply because hard economic times, we've got things like war, okay? In 2022, I believe that kicked off, which is, where we're looking, about this point, somewhere around here, war kicked off, Russia, Ukraine. Obviously look at it since then. We have many other economic problems, a lot of things going on that basically people say currencies inflated, at danger of, geopolitical events, they're not so good to hold. I'd rather have my money somewhere proven and safe. So people then put their money into gold. That creates less supply, more demand. And this mix creates the perfect concoction to take us to, $4,600 per ounce, when a few years ago we were trading really never above 2. So another one of those is silver. These are two things I've been holding very long-term trades on. I've been holding a silver trade from down here, and we are now at $91, which is absolutely insane. So that trade is up like 400%. Why? Because simply the same reasons, right? Around exactly the same time, we started to see war, major geopolitical events. We were already kind of in the mix with COVID, pandemic, things like that. But now silver's gone absolutely parabolic. So that is why that happens. We see more demand coming in for safe assets. People buy that and then price appreciates because supply is shrinking and demand is increasing. And if you're holding silver at this level, if you, for example, if you bought in where I bought in, and now people are like, please, I really want some silver, you can say, well, I'll sell it you for this much, I'll sell it you for this much, I'll sell it you for this much. And that is exactly what's happening, all right? That's how silver is doing, as amazing as it is doing right now. So then another one we can look at real quick before we get into actually trading the theory is USD JPY. If we look at this on the monthly perspective, we can see the dollar has been appreciating against the yen very aggressively. This one comes down to their interest rates and monetary policy. So both of these are safe havens. So you should expect that if one does well, the other should do well, right? That's how it would seem on the surface. A safe haven currency, you know, like we've seen gold and silver do well, we don't see one beat the other. You would expect that USD and JPY would move in pretty much the same sense, but this has the currency differential of interest rates, yields, and monetary policy. So as we said, the US has had interest rates at like 4% plus for the past few years since really trying to defeat that pandemic. Whereas that's because they were seeing inflation, right? So this was because of inflation. However, if we look at the other side of the picture, at the Japanese yen, the Bank of Japan was actually seeing deflation. So they have interest rates actually at zero and sometimes negative, right? So they sit in this zero and negative range, which is pretty wild. But this is because of deflation or disinflation. So basically their economy is just really not growing. There's obviously a lot of problems in Japan regarding the economy, population, things like that. But their economy is so flat that they have yields so low that borrowing is so cheap to stimulate the economy and get people spending money, okay? So that's why they do that. And then if we think about the US, their interest rate is high because inflation started spiking. So they wanted to slow down the amount of money people were spending. They make it more attractive to save. That creates demand to hold an asset. And they make it less attractive to invest or to borrow, even less attractive to borrow. So with it being less attractive to borrow money, businesses slow down, take less risks, and they just hold the money instead of spending it, which of course can create demand because people are like, well, there's big yield here, there's no yield here. So I'm gonna move my money from Japanese yen into US dollars and hold that. And that is why when you look at the charts, for those years, so let's say from 2020, around the time that the US started hiking interest rates, we've had pretty much nothing but direct upside. Because around this point, people started offloading yen and buying dollars, okay? And that is a case where demand increases, supply decreases, and the US dollar massively outperforms the yen. And that is why since around this point, we've seen nothing but pretty much clean upside for USD JPY. There's that disparity between supply and demand between the US dollar and the Japanese yen. As we see those high yields for the dollar and low yields for the yen, we start to see dollar demand increase, which creates the supply decrease. And we see yen demand decrease, which creates the supply increase. So with more money going out of the yen into the dollar, we see this on USD JPY. So now let's talk more about how we actually utilize this on the charts. I think I've gotten the theory across quite well, and you should understand pretty much what it is that drives the force behind this concept. Okay, so now that we've pretty much in full explained the theory behind supply and demand, talk about how we actually trade it on the charts. So when it comes to identifying and utilizing supply and demand on charts, we use something we call supply and demand zones. So these are basically price areas. This is how you've got to think of it. It's a price area that the market has created impulsive movements from that could therefore be utilized in the future for us to find good points to get into and sometimes out of trades as well. So what we have here is basically a indicated price move. So just imagine this is a candlestick movement or a price move in the market. This is obviously a bullish price move because the market's moved up. And at the start of the price move, we have a small kind of consolidative area where the market moved sideways a little. Now this area here, the consolidation before the drive higher, is a demand zone. So we classify this as a demand. Now, the reason we know this is a demand and how we spot it in real time is basically after the small consolidative move, we have this large impulsive bullish push, right? This impulse higher, therefore, indicates that from this price area, we saw demand enter the market. Okay, so if you think about the logic behind what's actually happening, we have sideways price and then an explosive upward move. That shows us that somewhere in and around this area where the market went sideways, we saw a big influx of buyers. Okay, so a lot of people want to buy there. So buyers or owners of the asset keep pushing the price up and buyers keep paying that increased premium. All right. So what does that tell us? Well, it tells us that at this point, specifically the demand zone we have marked, this is where buyers stepped into the market in large numbers. So that is then classified as demand. So how we use this in a market then is if we understand where buyers are stepping in massive numbers. Take it back to what I said about it being a price range rather than just a rectangle you've drawn on the chart. It tells us that between 250 and 260 in this example, using these numbers over on the right, we saw lots of buying come in. So if we think about the auction theory, that tells us that between 250 and 260, this was a good price to buy this asset. People saw this as a discount, okay? So because we saw a lot of demand pushing in from the 250 to 260 area, we could then anticipate that if the market was to return to that 250, 260 range, we may see another influx of buying, which could drive us to new highs because we already know this price is proven as a discount price to buy from. So if the market can get back in there, well, anyone that wanted to buy, but now sees, these higher prices as too late to buy, they will think, okay, we've returned to a discount price. We're at a good price range again. So I'm going to get in, and that can set the new baseline to drive the market higher. Okay, so that is how a demand zone works. It's basically a price range between one level and another level where buyers went heavy before, and if the market returns there again, it's already proven as a discount price. So providing the market is trending to the upside, we should then be able to basically use these pullback movements and the demand zones that come out of them to secure buys from there, given that a large number of market participants already see this as a discount or a good price to buy the asset. So that is how a demand zone works. We are basically identifying where did buyers buy in force before. If the market returns there again, that's where we should look to buy from because we know this is seen as a discount price in the market and we're likely to see another impulse from there again. Okay. So when we're buying in a market, we do not want to buy on the way up. We basically want to buy on the way down, but in a larger upward price move. So if we have a movement like this, we are not trying to buy here. We're not trying to buy here. We're trying to buy at these points. And this demand zone theory that I've just showed you is exactly how we make that happen. Now, let's flip this upside down real quick. This then is a supply zone. So this is the opposite. It works in the same way. You probably already understand if you got that example. But basically, we are seeing here a price range where sellers entered the market in large numbers, right? So if the sellers entered in large numbers here before, which obviously is indicated by a sideways move and then a large drive down, so this impulsive movement shows seller control. So we see sellers stepping in, buyers sell the asset to them for this price, then this price, then this price. So sellers are basically controlling the market. There's more supply entering the market. Demand is decreasing. So sellers have to sell this off for cheaper and cheaper and cheaper and cheaper until demand is met once again by the buyers. Now, if we then see the market pull back to this level, we know this is seen as a premium price to sell the asset. So anyone who is in a buy will want to get out as high as possible. So they'll be selling into a supply zone like this. And anyone that is wanting to sell would want to sell for the highest possible price because obviously then they make a good return, providing they're not, of course, short selling the market. So basically, if we see the market return to here, we're going to see people sell again. Same if you want to short sell the market, so you want to get in and profit from a down move, you want to do that from as high as physically possible, right? Because the higher you sell from, the larger down move you profit from in your short sell trade. So a supply zone is pretty much just the opposite of a demand zone. This is the selling version where supply is stepping into the market in force. This is the example where demand is weaker, supply is stronger. And what we want to do from those is sell the market once we return to what is seen by mass market as a premium price to sell. So that's a supply zone. Demand zone is the buy side version. And now we'll go and look at these on an actual candle chart. Okay, a quick interruption, quick little note. What you're learning here in the bootcamp about technicals is absolutely necessary, but technicals alone are not sufficient to get you to where you want to go. You're not going to win just off the charts. Whether you believe it or not, whether you've noticed it yet, most traders don't get stuck because of what they see on the charts. They get stuck because of the bad habits, risk behavior, decision-making under pressure, and self-sabotage patterns that develop in their trading over time. These are things that simply don't show up in technical analysis. So if you want to get to the bottom of these and diagnose the problems you have behind the scenes in trading, I've got a class, there's a link in the description. You should finish this bootcamp episode first and then head over and watch that because it's super valuable. There's a link in the description after this. And with that said, let's get back to the bootcamp. All right, so we're going to visualize the theory now on a real candlestick chart. This is kind of what it's going to look like when you're in real time trading the supply and demand concept. The first thing is, of course, we want to make sure we are moving with the trend, okay? So in the previous episode of the bootcamp, we talked about market structure, which was the idea of trading with high and low structure in price. So a downtrend would be just like what I've visualized on the chart, when the market is continually creating breaks of structure to the downside and also then printing what we classify as lower lows and lower highs. So every low is lower than the previous, all right? And every high is also lower than the previous. So we have lower lows, lower highs, and that constitutes a downtrend. Now, if the market is downtrending, we only want to look at supply zones within the current downtrending phase of price. We do not want to look at uptrends, right? Or demand zones. Because if we look at demand zones in a downtrend, we will get destroyed. Basically, because supply and demand is a concept that visually seems to appear everywhere, that's why I explained the concept and theory for so long at the start of this video, we need to understand what it actually is so that we don't trade on the wrong side of it. Now, if a demand zone is showing an area where significant demand stepped in and drove the market higher, well, then that means it has to exist in the context of an uptrend, because obviously, otherwise it didn't drive the market higher, right? So a zone like the one you've just saw me mark on, which would be like here, is not one we would be interested in because prior to that, we've got a downtrend of lower lows and lower highs consistently forming. So we don't want to buy in this scenario. We only want to look to sell, okay? So given that we have a downtrend in motion here with these lower lows and lower highs being printed, we want to focus on supply and we want to pretty much just totally ignore any demand zones that we may see in this market because they are not going to give us viable information to take trades. We don't want to buy demand in downtrends. We don't want to sell supply in uptrends, all right? So now that we've determined which way the market's going, which in this case is down, we understand we want to focus on supply. We would then get to marking up relevant supply zones. So the supply zone I've got marked here is basically the gray candle. And this is how you actually plot supply and demand. So you want to look for an impulsive move in the market, like what we've seen here. And then at the start of that impulse, you want to identify the kind of crossover point where this move began. Okay, so what we're looking for is the point of which sellers took control of the market from buyers. So if you take a look at this candle here, this is the point, that crossover between where buyers lost control and sellers took control. After this gray candle with the open there, the close there, and equal wicks either side, we had an impulsive move to the downside. So this becomes our supply zone. Okay, that's the point where sellers took control of the market from buyers. Now, as you can see, after the supply zone, we have a large impulsive move down, and that is going to be the impulsive selling move that we want to basically trade off of. It's what gives us the information. We see, okay, sideways crossover point, then a big sell down from the sellers. Therefore, we see this was definitely a premium price for sellers to sell from previously. That means if the market gets into here, we're going to see this is a premium selling point again, and we are likely to see a continuation of selling take place from this zone. So as you can see, downtrending price, as you can see, supply zone, these two things paired together give us good trading opportunities. So if we wanted to sell this market, we won't worry about targets for now. You would basically sell the supply, you'd put your stop over the zone. The idea being, if the market drives through the supply, that's what we call a supply fail. We're gonna have a full class on supply fails later in the bootcamp, okay? But that would be what we classify as a supply fail. And this is actually a bullish sign at that point. Buy examples, buy trade ideas come in from there. So we want to see the supply zone react perfectly. Basically anywhere inside this range but not above it is fine. So for positioning stop losses, we just put them over the supply zone And then targets wise, we pick a random target, we'll go there for this trade. But that's how your trade would be positioned. You're selling the supply, stop over the high, target wherever your target was going to be based on other factors. Now, what you will see from the market a lot of times is we return to the supply zone, okay? This is basically the short-term buyer control. And more so from a buy perspective, this is oftentimes just what we call relief or exhaustion from sellers. So sellers who got in here will have some taking profits here, and so on. Eventually, the selling control will dry up simply because the sellers in the move have gotten out. So when we see this upward move taking place, if we're in a downtrend, it's less so that buyers are incredibly strong and more so that sellers have stepped out of the market with a profit and are now awaiting a premium price to be remet. So this will be the premium price level, and obviously, as we've discussed, we are expecting to see this movement down. So as you can see, after we tap that supply, we then go for the large bearish move, which brings us so far to around this point, and yeah, allows us to catch a profitable downward move, basically by just following the trend and using that supply zone for our entry, okay? So you understand why this is happening. We basically are seeing sellers stepping in at a given level. We then see sellers exhausted, a bit of relief in the market where buyers take short-term control. And once we re-meet a premium price, any sellers that maybe did sell here and want to get back in, or missed the chance, missed the mark to sell here and want to get into this market on the short side, they're rejoining when price trades back between those two premium price levels, which in this case will be between 1.1738 and 1.1755, okay? We get back into there, we see that large selling move, and that's what you can capitalize on in a simple manner by using these zones with the trend. Now for a demand example, here's our zone. We've basically selected the final candle before the impulse. In just one moment, I'll talk through how I plot the zones and how I choose the candle to actually operate as demand and supply. But we have here an uptrending market, okay, making higher highs and higher lows. As we know, that's the kind of picture we want to see. So we only want to focus on demand in an uptrending move like this. We don't want to focus on supply zones because the market is telling us that structurally it is bullish. So therefore we only want to buy. So in a market that's structurally bullish, the impulsive moves are telling us demand is higher than supply. Therefore, we are expecting demand to continue. So in this move, we have our demand zone. Then we have an impulsive push. So we're marking the consolidation area before the impulsive move. This is seen then as the price range between 155.24 and 155.04. If you look over to the right there, that price range was seen as a discount price to buy from. So as we expect, following the standard logic, if the market returns to that level, we're going to see that as a discounted price to buy. Therefore, we should see new buyers stepping in at this level. That's where we would like to join the market, okay? So trade-wise, we do not want to buy up here because we are likely to see some exhaustion or relief at some point soon. Buying here will give us terrible risk reward. We prefer to then opt for a buy on the demand zone with stops beneath. Again, we just put them right below the zone because if this zone fails, that will change the narrative. We'll talk about supply fails in the future, as I said. Targets wherever you were going to target. We won't worry about targets for this class. And then simply place the order. And as you see, the market makes its movement back towards this area of demand. And then after tapping into the demand zone, has a rally away. Now, an important point here, an interesting point here, should I say, is the momentum as well. In class number 1 of this bootcamp, we talked very briefly about how momentum can indicate who's in control. Everything we're doing in the market is about reading control between buyers or sellers and seeing who is actually holding, you know, the most control over a market, whether it's buyers being stronger than sellers or sellers being stronger than buyers. Here we can clearly see strong, fast impulse, doesn't take a lot of time. The candles are very big, strong, fast, little to no wicks. The pullback we see, slow, choppy, sideways. We don't really get strong impulsive nature there, do we? And then as soon as we hit this zone, we start to see those big, impulsive, small wick candles reforming and running the market even higher. So we're in a position here where the momentum is on our side. Now, in terms of supply and demand, this does become relevant. Again, spoken about in the future in the bootcamp, but I just want to show you that because really what we're doing here with everything we do in the markets is reading the story, okay? The story here tells us from a momentum perspective, buyers are clearly stronger than sellers in this instance, all right? So there we go, that's how demand works. We identify the area of sideways or consolidative price action before an impulse. When the market returns, we buy, we take this market higher. Again, Just that important note, we don't worry about supply zones in an uptrend. So, you could see supply here, for example, this little sideways candle. We don't care about that because the market is overall telling us that we are moving to the upside. As long as we are moving pro trend, which is why market structure is so important, then this demand and supply focused way of buying and selling into markets is one of the most logical, first of all, and accurate, second of all, ways that you can get yourself into trades. Okay, so something I'm sure you probably want to know is exactly how I plot demand zones and supply zones and how I choose the candles that I'll be using for supply or demand. Now, we're going to look at this bit of price action. It's not the cleanest, it's not coming out the best trend, but just focusing on the areas I'm showing you as we go, because it will give you an understanding as to how we plot supply and demand zones, okay? So we're going to focus in on this area first of all. If you've been in supply and demand trading for some time, or you've watched pretty much any video about it, the majority of people use the simple rule, the last down candle before the up move or the last up candle before the down move. I honestly think this is okay. If you just want to operate with that format, I don't think you'll run into significant problems, but I do look at things very slightly differently, because I kind of worked this out myself, that this seems to work better and it makes more logical sense to me. So what I do, instead of the last down candle before an up move, or the other way around, I use the last candle before the impulse. So to identify an impulse, we are looking for, of course, a bullish push or a bearish push, a strong move. And generally it's going to create what we call imbalance. Now, imbalance is going to be covered in a future bootcamp class, but to explain it in the most simplistic format so that you can start practicing plotting zones, it's an open price range created by a large bullish candle or a series of large bullish candles or bearish candles. So here we have our indecision. We have two indecisive candles. We know this because the wicks either side are equal, so it hasn't really made any movement one direction or the other. The next candle, obviously very bullish, and this would be impulsive. The impulse has created what we call an imbalance, which is a gap between this wick and this wick. So you see this bit of the candle body, nothing has traded through it yet. That creates an imbalance between where price currently is up here and where price was down here. So that is how we identify the impulsive move. Then what I'm looking to do is basically select the final candle before the impulse took place. So for me in this example, rather than using the standard rule that a lot of people use of the last down candle before the up move, I would be using the last candle before the impulse. So I'm going to look at this basically as the zone that I would want to buy from. Okay. So should the market return to that level, we would then be looking at buying from the range of this blue candle in this example, because that's the last candle before the impulse away. So now if we take a look at this second area, which is going to be just here, we have basically a little pullback, consolidative move, and then we have an impulse away. Now in this case, it's slightly different. We're not going to use the blue candle here. Why? Because the impulse actually came from this initial blue candle. You see the first imbalance created is between this wick here and this gray candle just here. So this blue candle in itself is actually an impulsive candle. Therefore, it's not the last candle before the impulse, it's the last candle of the impulse. So the demand zone I'd prefer to use in this example would be this gray one. Okay, so that would be the demand that I would focus on. However, simple extra rule to come in here, so I don't want to confuse you too much. Basically, if we have seen the demand zone candle followed by a wick or a small pull down as a wick like this, then I will actually cover that wick with my demand zone as well, because I would expect that even if the market came down to this low, providing it stays above the low that we printed, it's viable. This works very well, okay? So this is why sometimes you may see a demand zone mark like this and get confused. I've had people complaining that I'm inconsistent with my demand zones when really they just don't understand. So that should answer any questions moving forward. Basically, I will be focusing in on this gray candle. I want it to at least meet this gray candle, but I just cover this wick to, number one, make it neater. Number two, account for the low that's been printed before the impulse away. So for this one, I would then want to see the market return into there to take any buys, and that would set me up for my opportunity, okay? Then we're gonna look at the third area now, which is gonna be just here. We have to decide which of these is gonna be the demand. Now, a lot of people would use the last down candle before the up move. Again, I think this would be mostly fine, all right, if you were focusing on this broader area, but I'm looking for the last candle before the impulse. So if we take a look at where the imbalance formed or where the move really began, well, there is imbalance between this candle here and this candle up here. So this blue candle is our imbalance. It's not this blue one. This is not the first impulse. This is the first impulse. This candle, although it is, not wicky, it's confined within the previous bearish candle, and it didn't create a notable imbalance to be a notable impulse. So our demand zone for this example is actually going to be this blue candle here. And for this one, I actually wouldn't go ahead and drag it to extend under this low because this is a previous candle. It's not a future candle, right? In this example, we're using the gray one and then the wick comes after it. So we would account for the wick on that case like this. That's basically the range we're looking at. But on this one, because this blue candle is the final one before the imbalance and there's no wick beneath it, I'd focus on this area. And if the market was to come under this zone, I would see that more as a bearish sign than a bullish one. So I'd be more interested in looking at sells there. Again, we get to demand fails, supply fails in the future. But that's how I plot demand zones. 3 different examples there. This honestly is what most zones are going to look like. So you're not going to have to do these other things too often. You know, marking out above wicks or marking out including wicks. This is what most zones will look like. I picked a tricky example on purpose to show you the different formats that I will be plotting supply and demand from. But most will just look like one indecision candle before an impulse away, and you just use the last candle before the impulse. That imbalance rule, that open price range rule that I just gave you, makes it very, very simple to actually plot these zones, okay? So that's how I plot them. That's how we mark supply and demand on the charts. Now, while we're here with these demand zones marked out, you might have the question, how do we select between zones when the market creates multiple zones? Well, there are ways and nuanced ways to actually identify which zone is going to be the best versus which one is going to be the worst. And you will learn about these more throughout the bootcamp, as we do need to introduce some of the other concepts like market efficiency in order for you to understand how to select the best zone. But a simplistic rule I will give you for now, so that if you are going to practice supply and demand, if you're going to do so, remember, do it in simulations. Don't risk real money. A simple tip I will give you on that, right, is to use some of the lessons we discussed previously in market structure and draw these over into your supply and demand concept. So if we were to see the market return to this zone, rather than just immediately buying from this zone and hoping that it goes up, we would look for a pattern that I call a standard confirmation, okay? I'm sure this will be discussed later in the bootcamp as well, but basically what we look for is on a lower time frame. So here on the 30-minute, we may go to the 15-minute to identify this. We would look for a point where the market structure shifts from lower lows and lower highs out of the zone into a higher high. When this formulates, you can then look to buy from the pullback, right? Just in the way we would. So basically, when we create this standard confirmation, we'll create a new demand zone on a smaller perspective, and you can actually buy only when that structure has shifted from down to up on, say, the 15-minute from this 30-minute chart. Now, if you follow this format, what you're doing is basically seeing agreement from the lower time frame here with what you're seeing on the higher time frame, which is this uptrending move. If this does not form and the market breaks through to the next zone, well, then you just look for the same thing from there. And if you get the pattern there, then you look for the opportunity. And again, if it doesn't form and it moves down to the lowest zone, well, this is where things slightly change. This is the most simple zone to buy from. So the furthest zone away from where price is trading inside of a leg of price action. So this is our leg of price action. This is where price is. This is the furthest point. This is what we call the extreme zone. Okay, so it's literally just, farthest on the extremity, I suppose. But because it's the extreme zone, it's basically the final point of which the market could provide a reaction to us that would remain valid. So if the market does not react from here, it completely changes the bias because it would break through the low and turn into a downtrending market, okay, as discussed with reversals in the previous class. So the highest probability in terms of entry and probability of winning, and also the highest risk reward, is generally going to come from the extreme zone. So you can actually go ahead and place the buy limit or the sell limit, as we've discussed throughout this class for the majority of trades, at the extreme. And this is the point where you either make or break. You either win or you lose, but a new opportunity opens. Now, the reason I advise against using buy and sell limits on middle zones and top zones like these ones, for example, is because if this zone breaks, okay, and we end up losing this trade, so let's say we use a buy limit here, market goes down to here, you've lost a trade, but the identity of the direction of the market has not actually changed, right? This is still a bullish market, given that we are still within this leg of price action, but now you've lost a trade. If you use a buy limit here as well, and the market decides not to stop there, well, now you've lost 2 trades, but still the identity of the market and the overall direction is still bullish. So you've lost 2 trades without even being wrong, okay? You're not actually wrong on this trade, yeah, it is still bullish, but you've lost 2 trades even though that's the case. Now, with the final zone, the reason it's okay is because losing this trade means we are wrong. It means the directional bias of the market has changed. That allows us to take one clean loss and then reverse into the new market direction. So extreme zones are the best to use there because you are basically taking a trade from a point where you either win or you're wrong and a new idea forms, okay? So don't buy limit every zone because you can be right and still lose, and that's a bad position to ever be in. If you're gonna use buy limits, instant executions, you wanna do that from the extreme zone, which in a demand zone example is gonna be this one, the furthest from the high, and in a supply zone example would be this one, the furthest from the low that price is currently trading at. And anywhere in between, you just use what we've already just showed you as the standard confirmation, where you wanna see the lower time frame structure shifting to create higher highs. Then you use the standard demand zone rules that we've just been talking about in this class, and you buy from there to take the market higher. If you see this pattern inside of this zone or this zone, then you're free to take the trade. If you don't see the pattern, then just don't take a position and focus your buy limits or your sell limits on the extreme zone furthest from price. So that is pretty much everything we need to discuss about supply and demand up to this point in time. I've explained the theory to you, how we plot supply and demand zones on the chart, and how you actually utilize it in line with the trend in order to take trades. As we get further throughout the bootcamp, we'll also talk about things like supply and demand fails and how we can turn these into opportunities. And we'll just go a little bit deeper into supply and demand as a whole and how it aligns to the other concepts that we're going to discuss. But for now, you understand the foundations and you probably understand the theory of supply and demand and why that matters more than you ever have previously, or at least I would hope so. So with that said, that's the end of this class. Hit the link in the description if you want to check out that additional class that diagnoses why you're losing at trading. And with that said, I will see you in the next episode of the bootcamp.